Hello, good afternoon, everyone. Welcome to the marketplace. Coming up in this bulletin, Bank of Ghana Governor Dr. Johnson Isiama promises to press ahead with reserves accumulation program to help withstand global commodity price shocks.
FX intermediation, very little by way of, even if we have to stem excessive volatility, that's the approach.
We will also be discussing how the policy rate cut to 18% aligns with Ghana's economic outlook. Also in this bulletin, average lending rates fall sharply to 22.22% in October 2025. We have details in the latest summary of economic and financial data by the Bank of Ghana. Plus, government begins negotiations with the United States to secure Ghanaian exporters access to the U.S. market under the African Growth and Opportunity Act, AGOA.
We are negotiating on AGOA as well so that Ghana can have the U.S. market restored for our garment manufacturers.
These and more line up for you. Please stay on. Grateful you could stay on. I am Pius Kojobaka, looking at our stories. Average lending rates have fallen by more than 7 percentage points since the beginning of 2025. That's according to the Bank of Ghana's November 2025 summary of economic and financial data. The average cost of borrowing, we know, stood at 22.22% in October 2025 from 30.07% in January 2025. More in this report. From 30.07% in January 2025, the average lending rates increased to 30.12% in February 2025, but fell to 29.18% in March 2025. It further decreased to 27.40% in April 2025, and then to 26.90% in May 2025. However, it rose marginally to 27% in June 2025, but has since taken a dive. Similarly, the Ghana reference rate has also fallen sharply to 17.86% in October 2025 from 29.72% in January 2025. The central bank cuts its policy rate to 21.50% in September 2025, citing sustained disinflation, strong economic growth, and an improved in external buffers. The average lending rates, however, vary among the banks and the respective sectors they lend to. Some banks offer loans equivalent to the Ghana reference rate, whilst others will charge rates as high as 39%. This, however, depends on the risk profile of the customers. Now, Governor of the Bank of Ghana, Dr. Johnson Isiama, has vowed to press ahead with the reserve accumulation program to help withstand commodity price shocks. There is more in this report.
According to the Governor of the Bank of Ghana, this will ensure that the country can withstand the expected challenges if gold prices and other commodities start dropping.
FX intermediation, very little by way of, even if we have to stem excessive volatility, that's the approach. And that will continue to be it. And that's the best way to shoot, to shore up against any changes in commodity prices.
On proposals to hedge gold prices, the governor noted that the move has been frozen.
The approach for now is to rebalance our portfolios, and that is what we are actively doing now. We have different components of our portfolio. We are rebalancing those ones. And so we are sure once we rebalance properly, there may be less of a need, for hedging. We haven't completely abandoned it. We are only doing the rebalancing first, and then we'll assess the scope, whether to do some bit of hedging in addition.
Dr. Johnson Isiama also assured that he remains optimistic of interest rates dropping to single digit at the end of his tenure as governor of the Bank of Ghana.
Gradually, as interest on T-bills and others continue to trend down, banks will have no choice than to do aggressive lending. So that is where you see a faster decline in terms of the lending rate going forward. So rest assured, it is one of the things I particularly want to be, assessed by the end of my tenure.
The governor of the Bank of Ghana also noted that he's not worried about the outlook of the economy, even though there's a strong need to build the necessary buffers and fast-track work on structural reforms, so as processing more things that the country currently exports.
All right, so let's broaden the conversation further and bring in economist Professor Peter Quartey. He joins us via Zoom. Pleasure you could make time to join us here on the marketplace, Professor Quartey, and good to see you. First off, let's understand how significant this 18% drop in the lending rate is considering the country's inflation trajectory. Are you satisfied with the margin of reduction?
Good afternoon to your discerning viewers and listeners. Yes, in fact, it was beyond my expectation. I was expecting a decline in the policy rate, but not by a significant margin. My expectation was going to be in the range of 1 to 2 percentage points decline, but this one is quite drastic. And I expect this to trickle down to the banks so that lending rates could also come down.
Even before we come to, its attendant effect on lending rates, etc., the governor spoke about the fact that, well, he's optimistic about the economy, and largely, I bet you would agree with him.
Oh, yeah, I'm equally optimistic about the economy. I expect the economy to grow even beyond what has been projected. I expect something in the range of 5% GDP growth rate. But then we need to also be cautious there. The external outlook can be quite shaky sometimes. We are benefiting from a windfall in terms of commodity prices, gold and cocoa. And commodity prices can sometimes suffer some shocks. And therefore, we should cushion ourselves against any such unexpected shocks should it happen.
Talk to us about the attendant effect of this lending rate cut with regards to cost of borrowing and even, private sector growth.
Certainly, the decline, the reduction in the policy rate has to trickle down to lending rates. Although sometimes we have this stickiness downwards, we don't get an equal percentage decline in the lending rates anytime the policy rates are reduced. But one could also understand that we have such a high default rate in the system. I mean, if the NPLs are in the range of about 20% on average, banks, when they lend, would have to cover their costs and also be able to satisfy depositors. So we also have to work on the default rate. But overall, the decline will certainly trickle down to the banks. Lending rates will come down, and that can help borrowers or investors borrow more and invest and be able to grow their businesses. And in total, on the aggregate, we should see this translated into economic growth or GDP growth rate.
And this, of course, will also stimulate private sector credit growth.
Well, certainly, private sector credit growth is expected to. Gone are the days where banks were focusing on government paper, treasury bills, etc. Now, I think they're also channeling their resources into the real sector. So, with this decline, we are likely to see an improvement in private sector credit growth. But of course, as I mentioned, we need to work on default rates. Banks will have to streamline their credit appraisal systems. We also have to ensure that the courts are working very well to speed up some court action that the banks have taken against defaulters. And I believe together we will reap the benefits of a decline in the lending rates, in the policy rates, in the cost of doing business as a whole.
Professor Quartey, the governor spoke about the fact that banks would have to pursue aggressive lending. But again, you would understand and also appreciate the fact that it definitely would have to commensurate with interest rates, right? So how do we reconcile the two?
Yes, I believe what he's saying is focus more on the real sector. That's what he's pointing them to. Don't be buying government paper, treasury bills, etc. But rather focus more on lending to the real sector, and that's where the aggression comes in. But that you need to do proper credit appraisal. You need to really tackle non-performing loans. You really have to price such that businesses will borrow and also make profit. So that's where he's encouraging banks to move into.
Thank you so much, Professor Peter Quartey. I'm grateful you could make time to join us here on the marketplace with your input.
My pleasure.
All right, let's shift focus to some other stories. Minister for Foreign Affairs Samuel Okudzeto-Ablakwa has announced that government is actively negotiating with the United States to secure Ghanaian exporters access to the U.S. market under the African Growth and Opportunity Act, AGOA. The AGOA, which expired on September 30th, had provided Ghana with duty-free access to the U.S. market for over 6,700 products, including textiles, agricultural goods, and manufactured exports. However, Mr. Ablakwa emphasized that the government is committed to finding a lasting solution that safeguards livelihoods and sustains Ghana's position in the U.S. market. He spoke on the sidelines of the AU-EU summit in Angola.
We are negotiating on AGOA as well so that Ghana can have the U.S. market restored for our garment manufacturers. So we welcome this development. It's good for the agri sector, it's good for Ghanaian farmers, and it is very good for agriculture exporters. And all the farmers who were worried about markets for their produce, the glut that we have, the high production, now we have a good market where you can have good returns on your investment. So we want to also encourage medium and small scale exporters and also entrepreneurs to take up this opportunity so that they can have good returns on their investment.
This is still the marketplace. We have more for you after this break.